Good evening and welcome to our special programming this night. Tonight, my name is Shahiwa Jarrett Gellin, and I am the founder and president of the Broward County Black Chamber of Commerce. Now, you know that we like to make sure we're keeping you up to date on the information that's important to run your small business successfully. And as we enter this new year, there are a lot of unknowns. There are a lot of different things that can impact your business, and we need to know about them. That's why it's important to talk to the experts. As we enter 2022, there were a lot of questions concerning the economy. Is it going to go up? Is it going to stall? How will the coronavirus impact the economy going forward? There's a lot of talk about inflation and shortages. So let's not assume or make our own assumptions as we listen to the different TV programs and people trying to analyze, or our friends analyzing the economy and what may or may not happen. As small business owners, we have to utilize concrete, valid information. And that's why we have an expert with us tonight to share his outlook on what is going to happen in the economy for 2022 and the important things that small business owners should be paying attention to. I'm very pleased to welcome Olu Omodombi, who is the Assistant Vice President and Senior Economist for PNC Financial Services Group. In his role, Omodumbi is responsible for contributing to PNC's regional, national, and international economic analysis and forecasts, including coverage of the metropolitan area economies throughout PNC's footprint. In addition, Omodumbi also speaks frequently about the economy to PNC clients and regional media. Prior to joining PNC in October 2018, Omadumbi spent 3 years in risk management at Goldman Sachs in New York. He earned his PhD in economics from State University of New York with concentrations in labor economics and econometrics. I want him to explain to me what that is. Okay, I'm very interested in that. He also has a Bachelor of Science in Mathematics from New Jersey Institute of Technology. Without further ado, welcome my guest, Olu, as we so friendly know him now. We're getting to you.
Thanks for having me, Shahiwa. It's a pleasure to be here. So today I will be sharing PNC's economic outlook, and I will just try to share my screen. Just see if that works. Share screen.
Will it allow you to share?
Okay. Yes, it will. Just
Okay.
can
I
you see it?
see. Yeah, I do. Go
Okay,
ahead.
great. So the U.S. economy has made a strong recovery from the viral recession. GDP is above the pre-crisis level, and we've also made strong improvements in the labor market. So before I go into the details of my presentation today, I'll just go over the main points. So we're expecting a strong economy this year. We're going to see solid economic growth in 2022. Consumer spending and business investments will drive the U.S. economy. The inflationary pressures, which Shahira referenced, are going to moderate this year. Um, the unemployment rates will decline to the pre-crisis level by the end of this year. We're also expecting the Fed to increase Fed's funds rates 4 times this year. And finally, structural changes have been accelerated due to the pandemic. I'll talk about this later on. So before the viral recession started, the U.S. economy was in very strong shape. Consumers were doing very well. Businesses were doing very well. This chart shows you the real median household income, the year-over-year change. A few things I'd like to draw your attention to. First, as you can see, in 2008, when we had the Great Recession, we saw a strong decline in real median household income. That's the blue bar. You can see it was a pretty um, steep contraction in 2008. And from 2015, we've been seeing very decent increases in real median household income until 2020, when the viral recession started. The viral recession was a service sector recession, so the fundamentals of the U.S. economy were strong. Consumers were doing well, businesses were doing well. The banking sector was in great shape, but this was really a public health crisis, which ended up um, evolving into a recession. So while consumers were doing well, business debt was more of a concern. Many businesses loaded up on debt. So corporate debts as a percentage of GDP, which is the blue line here, it was at a very elevated level. So that was more of a concern before the viral recession started. But the good news is we're officially in a recovery. The viral recession lasted just 2 months, from February 2020 to April 2020. Um, since the recovery started, so far we're about 21 months into um, the recovery. And I expect the recovery to go well into 2023. Consumer fundamentals are very solid. Consumers have saved up so much in the past couple of years. A lot of consumers weren't able to travel or go to theaters due to lockdowns. So consumers ended up saving up a lot, and that's going to help drive the US economy in 2022. So we're officially in a recovery. We're 21 months into a recovery, and I expect the economic recovery to last well into 2023. So looking at various measures of economic outputs, the recovery has been very strong. On this chart, I have three measures of economic outputs. The first is GDP, which is the most widely used measure. Another measure is gross domestic income, which is the income earned by producers of goods and services. And finally, final sales of domestic products. Now, looking at all three measures, as you can see, we saw a strong contraction in 2020 due to the viral recession. But looking at all three measures, we're now above the pre-crisis level. So we've made such a strong improvements, and economic outputs, which is the value of goods and services produced in an economy, is above the pre-crisis level. So again, it's been a very strong um, and sharp recovery so far. Compared to recovery in 2020 to the recovery in 2008, if you look at the chart over here, it took the US economy about 1.5 years to return back to the pre-crisis level. So this was pre-Great Recession. We saw the decline, and it took the economy about close to 2 years to get back to the pre-crisis level. Compare that with 2020, where we lost 10% of the U.S. economy in 2 months, but then it took us just about um, a year to return back to the pre-crisis level. So it's been a very, very strong recovery. But while it's been a strong recovery, it's also been very uneven. So there are many sectors of the U.S. economy that are still below the pre-crisis level. Um, it's also been very uneven in terms of classes. So you find out that like upper income folks have done really well in the past year and a half, whereas lower income folks like salaried workers haven't really done as well. So it's been a very uneven recovery. Um, this chart shows you various sectors of the U.S. economy. I'm just going to talk about a few sectors. The blue bar shows you the direct impact of the viral recession. That's the change from the end of 2019 to the middle of 2020. This is when we had the recession. The orange bar shows you where we are now, the recovery to date. So looking at spending on consumer services, so this was by and large, the viral recession was by and large a service sector recession. So folks that work in restaurants, in retail, in travel, they bore the brunt of the recession. So spending on consumer services declined by 15% in the first half of 2020. Um, so far, we've done very well, but we're still about less than 1% below the pre-crisis level. So a lot of folks still don't feel comfortable venturing out or going out to theaters or going out to games or going out to or traveling out. There's still lots of restrictions on international travel. So spending on consumer services is still below the pre-crisis level. The next category I'm going to talk about is spending on consumer durables. Now, this category explains a lot of what's going on in the US economy now. It explains the inflation. It also explains supply chain disruptions. So when we had lockdowns in 2020, when we couldn't, venture out and travel like we used to before, in 2019, a lot of folks ended up spending a lot of money on goods. So we spent a lot of money ordering on Amazon and Etsy. Folks spent money on home appliances, on bicycles, on cars, and that ended up having the consumer durables 20% above the pre-crisis level. So in the first half of 2020, spending on consumer durables declined by about 3%. But because of all the spending we were doing on goods, not services, we're now about 20%, over 20% above the pre-crisis level. So usually in the U.S. economy, when things are working well, we spend more money on services. But because of the nature of the pandemic, folks couldn't go out, folks couldn't travel. We ended up spending so much money on goods. And again, this explains what's going on with the inflation because now there's been so much strong demand for goods and suppliers aren't able to keep up with the demand. So there's been turbocharged demand for goods and the production facilities are just nuts. Um, Set up in a way to meet up the strong demand for goods. And this is why we're seeing delays in ports, we're seeing shipping log jams, we're seeing a shortage of truck drivers, we're seeing challenges in warehouses because the, the production capacity is just not set up to meet this strong demand for goods. And that's why we're seeing supply chain disruptions. And that's also why we're seeing inflation because inflation happens whenever there's strong demand for goods and the supply can't keep up with it. So if there are only 10 calculators in this world, and if 200 people want a calculator, I mean, what happens? The sellers of the calculator are going to raise the prices up. So that's exactly what's going on, and that's why we're seeing an increase in prices. So we've seen very high inflation readings um, in recent reports. As of December, inflation was about 7%. This was the highest in over 20 years. But I expect inflation to settle in 2022, and I'll talk about that later in my slides. Another sector of the U.S. economy I'd like to talk about is exports. This was by and large a global recession. So the euro area, Japan, China, you know, global economies felt the brunt of the pandemic. So many economies went through some sort of recession. So again, just you name it, Jamaica, Belize, Barbados, everyone had some sort of contraction due to the pandemic. And with that being said, U.S. exports were also challenged. So when we're producing goods and the demanders declined because many of those economies are struggling, it causes a decline in our exports. So US exports declined by close to 25% in the first half of 2020 as the global recovery has continued. We're still about 6% below the pre-crisis level. So exports are still not at the pre-crisis level yet because many other economies are still trying to recover from the virus recession. Actually, the US economy is actually at the forefront of the global recovery. So the U.S. economic recovery has been much stronger than many other economies. Brazil is actually currently in a recession now. China is experiencing slow growth. Um, England is experiencing weak economic growth too. So economic conditions are very good in the U.S. compared to many other economies. So finally, I'll talk about after-tax personal income. Usually, when there's a recession, personal income levels decline. In 2020, when we had the virus recession, we actually saw an increase in after-tax personal income, and this was mainly due to the fiscal stimulus programs from the government. So consumers got three sets of checks. Consumers also got extended and expanded unemployment benefits, so more folks were eligible for unemployment benefits, and also businesses, particularly small and mid-sized businesses had the Paycheck Protection Program, which provided a lot of financial cushion for many employers. So the stimulus has been the main driver of the economic recovery. And after-tax personal income levels are still about 3% above the pre-crisis level. So this is going to be very supportive of economic growth. This is going to help drive the U.S. economy this year. So another sector of the U.S. economy where we've seen an uneven recovery is the labor market. Um, Non-farm payroll employment is still down by about 3.5 million. So the U.S. economy still is about 3.5 million jobs down compared to the pre-crisis level. We're also seeing a lot of labor shortages. It's a very tight labor market, and which means there are more jobs than there are potential workers. So it's an employer's market right now. It's an employees market right now. Employees have options. We're seeing very strong wage growth because many employers are having to incentivize employees in order to take jobs. So about 3.5 million jobs below the pre-crisis level. We're seeing labor shortages, and there are a couple of reasons why we're seeing labor shortages. Some folks retired early. Some folks did really well in the past couple of years, and they chose to retire early, and they left the labor market. Many families had to leave the labor markets due to childcare disruption programs. So you used to take if a family used to take their kid to a daycare program, as many families don't feel comfortable doing that now, given that we're in a pandemic, and that's also part of the reason why we've seen a decline in the labor force. Um, I do feel that the pandemic has structurally changed the labor force, so I think it's going to take many years before um, we return back to the pre-crisis level of the labor force. So I think the size and the composition of the U.S. labor force has structurally changed due to the pandemic. So what people think very differently about work now, and it's just going to be a much different labor force coming out of the pandemic. We've also seen an uneven recovery in the real estate sector. So this chart shows you residential real estate, which is like single family homes, and non-residential real estate, which is like um, offices and malls and so on. We've seen an increase in residential real estate in the past couple of years. Remote work has contributed to that. So many folks don't need to live close to their offices anymore. So folks are moving, into the suburbs. They're buying bigger homes, and also mortgage rates have been very attractive. Mortgage rates declined to less than 3% in 2020. They've increased in recent months, but they're still very attractive for potential home buyers. So we've seen a strong recovery in residential real estate, but we've actually seen a decline in commercial real estates, mainly due for two reasons. First, work from home flexibilities. So as employees are working from home, many office spaces are empty, and this has caused a decline in demand for commercial real estate. Another reason why we're seeing the decline in commercial real estate is due to the Amazon effect. Um, Consumer spending patterns have changed. A lot of folks are spending online now. They're spending a lot of time on Etsy, on Amazon, and folks aren't going to malls anymore. So we're seeing many malls shut down, and has also contributed to the decline in commercial real estate.
Can I ask you a question, Olu?
Sure, sure.
With regard to the decline in the commercial, I know here in South Florida, there's a lot of acquisition of these former mall spaces to create this mixed use now. Um, so it seems that there's some residential, you get some extra residential units with, only a few commercial units. Do you think that plays into this? Because then, I mean, it's kind of like they're moving this huge commercial space right into residential space, and you lose that commercial space altogether. It's very interesting.
No, I think that's a great point. I think many real estate developers are going to have to get pretty, creative with what they
Mhm.
do with the commercial real estate space. So I'm based in Pittsburgh, and a lot of the space downtown is actually being converted to residential
Mhm.
space, just
Mhm.
like you mentioned. Something else we're also going to see is that we're going to see an increase in demand for warehouses. So as folks start working from home, and as a lot of work goes into like cloud computing and things like that. And as companies like Amazon and Walmart's just expand even more, that will even increase the demand for warehouses, which is going to offset some of the decline in demand in commercial real estate.
Got you. Okay, thank you.
Sure. So looking ahead, we're calling for slower house price growth in 2022. The housing market has been on a tear in the past couple of years. House prices now are about 48% above the pre-Great Recession level. So there's been such a strong increase in house prices on a national scale. Um, Again, the low mortgage rates have been very supportive of that. Um, Remote work has been very supportive of that. Folks moving from big cities to the suburbs, and also strong consumer balance sheets. Many consumers did really well in the past couple of years, either through the stock market or due to increase in their in home prices. And many folks are either like buying second homes or they're now investing because financial markets have been pretty healthy in the past couple of years. But looking forward, we expect there to be slower house price growth this year, mainly due to the increase in mortgage rates. As mortgage rates increase, that's going to soften the demand for housing. And also, house prices have risen at such a strong pace in the past couple of years. And that's just going to have a lot of people just standing on the sidelines, just waiting for things to cool off. So we expect to see house price growth in 2022, but much slower than what we saw in 2021 and 2020. So this chart is one of the reasons why I'm very optimistic about the outlook. Personal savings rates are still very high. Consumer spending makes up 70% of GDP. So when consumers are in great shape, the U.S. economy has a strong chance to keep expanding. So I'm expecting consumer spending to power the U.S. economy this year. Talking about inflation, we're also calling for moderating inflation this year. We've seen an increase in energy prices in the past months. Energy prices are going to stabilize as more producers come online, and also as OPEC increases supply. OPEC is the organization of petroleum exporting countries. So once they increase the supply of um, crude oil, that's going to help to stabilize prices. And I also think it's going to be very unlikely that we see 6% increase in price, another 6% increase in prices by November this year. So we saw 6%, say, in November last year. I think it's very unlikely that I will see an additional 6% this year. So I think so we do expect inflation to settle and head towards the Fed's 2% objective this year. We're also expecting the Fed to increase interest rates 4 times this year, and the Fed to start quantitative tightening, which is when it starts selling off the assets on its balance sheet. This chart shows you the Fed's balance sheet. It has increased so much due to the Fed trying to keep interest rates low. We expect a reversal in that trend this year. And with the Fed completing quantitative easing and running off its balance sheet, we're likely going to see an increase in long-term interest rates. So we have the 10-year Treasury bond ending this year between 2 and 2.25, but that's still going to be very low by historical basis. We also expect the 3-month Treasury bill to increase as the Fed increases interest rates. So with that being said, I'll just go over my main points again. I expect consumer spending and residential investment to drive economic growth. Inflationary pressures are going to moderate this year. PNC Economics is expecting the Fed to increase interest rates 4 times this year. And we're also going to see many structural changes being accelerated due to the pandemic. So, retail sector, we're going to see the Amazon effect. Commercial real estate, we're going to see a decline in that sector. And we're also going to see many companies diversify their supply chain networks. Finally, the risks to our outlook are weighted to the downside. The
Hmm.
pandemic is a big downside risk. If we have another variant, or if we're not able to control the Omicron surge, that could tip the U.S. economy into either slower growth or recession. China is a downside risk. If China's economy slows even further, that doesn't bode well for the U.S. economy. And finally, fiscal policy is an upside risk. If the Democratic sponsored bill is passed in Congress, that is good for the US economy. It means there'll be more jobs, and it's going to mean the US economy can improve its productive capacity. With that being said, I'm happy to take any questions.
Well, I thank you, Olu, for this because it was so, first of all, detailed. But I think what it does by giving us the facts, it helps to moderate, I think, the angst and the tension that some people feel right now.
Hmm.
Um, because what you just so calmly laid out for us is not really what we hear on TV, and that's why we wanted to do this. You talked about the savings rate that went up during the pandemic because obviously we're stuck inside. We spent a little bit more, but not as much as I guess we probably would have been spending on vacations and all these different things, which are more expensive than say a couple of home improvement projects. But I like the way you spoke to that because then we kind of have a pent up, savings that could lead to some spending in the future. Then, right?
Correct. Correct.
Right, right. Which has that upside for the economy, which is really important. And the last point I wanted to kind of make was the point you made with regard to where the squeeze was. Like it was in that service sector, but then there was some spending in some other the durables, the
Right.
spending in the durables, which then is causing, so it helps explain causing
Right. The inflation.
the demand and the inflation and
Yeah.
it puts it all together and it makes sense for us now when you have all these containers like offshore and what people are talking about and then it makes sense. Okay, now I get it why we have the inflation, but it's important for people to hear from you and the average small business owner to understand how all of this works and then obviously ultimately impacts their business. So for all the small business owners out there, this is good news. All that pent up savings and money that's sitting on the sidelines, you're expecting to come back into the economy, Olu, correct?
Correct. Correct. Yeah.
Very nice. Very, very
Yeah.
nice. Well, I thank you for joining us
Sure.
this evening. I really appreciate it. And we're going to have you come back because as we're in, Q1, kind of kicking it off in January. And, I think we've learned these past 2 years that you just never know what might be coming around the corner. So we look forward to having you back with us. Thank you so much.
Sure. Thanks so much. Thank you.
Well, I hope you all enjoyed tonight's program. We are extremely happy to have Olu with us from PNC Bank's um, Financial Services Group to lay out what we can expect for the 2022 economy. It's important as small business owners for us to understand the push and pulls and the pressures on the economy and understand how that can impact our small business. I really do mean it. We have to have him back because this is important information that we have to track so that we understand our economy overall, but then understand how that impacts our local economy and ultimately our small businesses. Thanks again, Olu, and thank you all for joining us this evening. Have a great